Welcome to County Portal, your simple source for local government services and public records. Let's get started.
Transferring corporation ownership involves changing who controls and benefits from the business entity. This is a significant legal and financial process. It happens for many reasons, like retirement, pursuing new ventures, bringing in new investors, or passing the business down to family members. Unlike a sole proprietorship or partnership, a corporation is a separate legal entity, so changing ownership means changing who holds its shares. The most common method for transferring corporation ownership is through a stock transfer. This means the current owner or owners sell their shares of stock to a new individual or group. The corporation itself continues to exist as the same legal entity, only the shareholders change. Another less direct way could involve an asset sale, where the corporation sells all its business assets to another entity, and then the original corporation might dissolve, but this is more about selling the business operations rather than transferring ownership of the corporate shell itself. For a direct ownership transfer, focus on the stock sale. The first critical step is accurate business valuation. You need to determine the fair market value of the corporation. This often requires professional appraisers to assess assets, liabilities, earnings, and future potential. Next comes due diligence. The buyer will thoroughly examine the corporation's financial records, legal documents, contracts, and operational history. This ensures they understand what they are buying. Simultaneously, the seller will prepare all necessary documentation for review. Legal documents are central to the transfer. A comprehensive stock purchase agreement is essential. This document outlines all terms of the sale, including purchase price, payment structure, representations, warranties, and indemnities. Other documents might include a bill of sale for specific assets, non-disclosure agreements, escrow agreements, and board resolutions approving the transfer. Shareholder agreements might also need to be amended or created for the new ownership structure. Tax implications are incredibly important for both the seller and the buyer. Selling shares can trigger capital gains taxes at the federal and state levels. The structure of the sale can significantly impact tax liabilities, so consulting with a qualified tax advisor is non-negotiable. Regulatory compliance is another vital consideration. Depending on the industry, there might be specific permits, licenses, or regulatory approvals required for the new owners. You must ensure all legal and industry-specific requirements are met. After the transfer is complete, internal corporate records must be updated. This includes the corporate minute book, stock ledger, and any internal operating agreements. You will also need to communicate the change to key stakeholders, such as employees, customers, vendors, and banking institutions. Professional guidance throughout this process is absolutely essential. An experienced business attorney will draft and review all legal documents, ensuring the transfer is legally sound and protects all parties. A skilled accountant will assist with valuation, financial analysis, and critical tax planning. A business broker can help facilitate the sale, from finding potential buyers to negotiating terms. Do not attempt to navigate this complex process without expert advice. Mistakes can lead to significant financial penalties, legal disputes, and operational disruptions. Careful planning and execution are key to a successful transfer of corporation ownership. Thank you for watching and learning about this important topic. If you found this information helpful, please give this video a thumbs up and consider subscribing to our channel for more business insights and guidance.